Okay, so we will be starting our webinar for today. I'll share a full screen. Okay, so this will be our today's webinar outline. So I will be brief through you on introduction to futures trading, and then for the local products, I will be using KLCI, the index futures, and also crude palm oil futures, and also will be review about introduction to the foreign futures contract as well. Okay. Okay. So what is futures contract? So futures contract is actually an agreement to buy or to sell an agreed upon the quantity for an underlying asset at a specific date and for a stated price. So besides futures contract, the standardized agreement that typically trade on the exchange. So in futures contract, you're able to enter the market when the market goes uptrend or downtrend. So it's like bi-directional trading. Okay, so what are the futures product that we would offer? So for agriculture, we have crude palm oil, which is the local one, which is one of our top traded products. And then we have corn, wheat, and soybean, the foreign products. And then for metal futures, we have gold, silver, platinum, palladium. And energy, we have crude oil, natural gas. And index futures, for the local one, we have KLCI and Hang Seng Index. And then the top four CME products, S&P 500, Dow Jones, Nasdaq, Russell, and of course, China E50. So what are the four elements in the futures contract which you need to know? Okay, before you enter into a futures contract, which also known as taking a position, traders should be aware of the main four elements for a futures contract. These instruments are like much different from buying shares in companies in stocks and exchange. So the first one, asset class. So for asset class, the contract will specify the asset that underlies the contract, which is crucial in measuring the value of the trade. For like some of the most highly traded assets in futures trading, we have energy product, agricultural commodities, precious metals, and equity indexes. And then the second one, we will refer to as the quantity. So quantity explains the size of the contract. It typically outlines the specific number of the units being bought or sold. So for example, one contract of crude palm oil futures gives the holders the right to acquire 25 metric tons of palm oil. Okay, and the third one is expiration of the futures contract. In a futures contract, it will have an expire date which will be set in the future. So the expire date is the final day of the contract can be traded, and after the date, the contract must be settled out. And lastly will be the price of the contract. It is ultimately determined by the open market, reflecting the value of the asset involved. A futures contract, however, will contain a specific price, like usually tied to the spot or cash price of the underlying commodity. Okay, so for the contract, they will also make sure you are clear about what are the currencies being used in the contract, such as whether the asset is priced in MYR or the other denomination. So in futures contract, we have two types of settlement, which is the cash settlement or the physical delivery. Okay, so for cash settlement, like in futures market, we do offer a wide range of products. We have energies, we have commodities, we have indexes. So and all of our agricultural commodities are settled by cash. So because like our traders, we are not farmers or meat processors, and we only care about the market price. So we do not, and the traders of course do not wish to take delivery of a live animals or a 25 metric tons of palm oil. So cash settlement, of course, required lesser time, and it is required lesser cost to deliver upon the expiration. So for cash settlement, it has enabled the traders to bring liquidity into the derivatives market. And next one will be on the physical delivery. So for some traders, they would prefer to deliver or take delivery of a commodity. So they will need to coordinate with their broker, the clearing firm, and the exchange in order to do so. But in Phillip Futures, for some traders, in Phillip Futures, for some traders who have CPO license are only able to do physical delivery. So for most of the retail traders like you and I, we do not prefer physical deliveries, as it would involve of costs like storage costs, transportation costs, and etc. And the next one will be on futures trading terminologies. So the terminologies are like, what are the things you need to know before you enter into the futures market? Okay, so for the first terminologies will be long. So for long and short is like, for long is like, I expect the market will increase or uptrend in value. And short, so it means that the market price might decrease or downtrend in value. And the bid price, it reach a buyer who are willingly to pay for the contract. And the ask price, we have a seller who are willingly to sell for the contract. And then market price will be the spot or current price of the contract. For settlement price, which will be used to determine the profit and loss for the day. And initial margin, the amount of money which are required to initiate a buy or a sell position. And the value per tick will be the minimum upward or downward movement of the futures contract. And lastly, we have the margin call. And margin call are when traders, they hold overnight position, and when the account balance falls below the margin required amount, so you will receive the margin call. Okay, so for the first one, introduction to KLCI index futures and crude palm oil futures. Okay, what is FKLI contract specification? So what is contract specs actually? So contract specs is actually like a manual. So like before you buying something, you will of course read through the manual on how to use it, how the things works, and what's the function. So same like in futures trading, you need to know what are the things before you start trading. So the first one, the FKLI contract specs will be the initial margin. Initial margin for FKLI will be 4,002. Okay, for every product will have their own initial margin. So same goes to FKLI. And the contract size is FPM KLCI times 50 ringgit, and the value per tick, which is 0.5 point, equals to 25. So for FKLI, it moves by every 0.5 point. And then settlement, because it is indexed, so it will be cash settled. And for trading hours, we'll be having 2 sessions. The morning session, 8:45 to 12:45. And then the afternoon, we have 2:30 to 5:15. And for the final trading day will be the last business day of the contract month. So what are the components in FPM KLCI? So one lot of FPM KLCI, it actually represents the top 30 companies by market cap on the Bursa Malaysia main market. From the pie chart here on the industry breakdown, you can see that the bank sectors, we have like public bank, Maybank, take up the highest weightage. Okay, and then the second one, we have healthcare and so on. Okay, this will be the current top 30 companies. Okay, so all these 30 companies equals to one lot of FPM KLCI. So when you are trading in the stocks market, you will be, if you are interested in all these companies, so you will be trading 30 times trading 30 times of all these companies. But in this futures index for local one, you will only need to enter one contract, one lot equals to all these 30 companies. Okay. And okay, so what will be the factors that would affect the FKLI market? So these are just a few examples. We have interest rate, oil price, and of course the COVID-19, which happens about 1 year plus until now, and then the political uncertainties and trade war. Okay, so I guess all of you also know that like during this pandemic and since last year, so the central bank also had announced to cut the overnight policy rate to ease the pressure of downside risk to the economy due to the pandemic. So like the banking stocks on Bursa Malaysia will fell after the central bank say that there is no ample room for another round of overnight policy rate. Okay, so the second one will be the oil price, and oil price actually have a big effect on the economy. So like during the economic expansion, So the prices they might rise as a result of increase in consumption, and they might also fall as a result of increase of production but lower demand. And Malaysia is one of the top oil producer, and in the oil sector, it is highly affected by a decline in demand due to the COVID-19 outbreak last year, as due to the lockdown measures has put the mobility to a halt. So because there are fewer drivers on the roads, and then public transport services were not running in many countries, so some offices also had shut down after the lockdowns and stay-at-home orders. Okay, so when the supply needs to exceed the demand, the storage space also has been running out, and these are the few factors that the oil price could turn into negative. And then the third one, we have COVID-19 pandemic, which it happens until now, and because due to also the economic uncertainties, and then it has pushed the KLCI below the 1,300 points to a 10-year low. And then the fourth one, we have the political reason. So politicians, they are highly responsible for the policy decisions and forming regulations governing the nation, which directly and indirectly affect the company, the local market, the import or export, and the purchasing power and economy as a whole. Okay. Malaysian equities market was expected to stay volatile due to the short-term policy uncertainties following the unexpected change in the country's political and the external challenges. And one of the main factors that has kept the investors on the sidelines of the local stock market is that the uncertainty over the planned handover of power between our government, the Prime Minister, and also the speculation on the transition aside, investors, they also prefer to wait for the dust to settle on the political front and there to be the certainty on policies before investing in the country. And then for lastly, we have trade war, which also refers to as the US and China trade war, which also brings a big impact on the performance on our index, because both of these companies have is the largest economy in the world. Okay, next, I also will be showing on FCPO contract specs. So, and as you can see from here, the initial margin for FCPO will be 6,000. And for just now, the FKLI, we have 4,002. So it may be vary from time to time. So it also will be based on the market volatility. And the value per tick for FCPO is 1 tick equals to 25 ringgit. So which means that it moves by every 1 tick. And the contract size is CPO price times 25 metric tons. So for the settlement will be physical delivery, but we only have cash settlement. And for trading hours, we have two sessions. The morning session, 10:30 to 12:30, and then the afternoon session, 2:30 to 6 p.m. So the final trading day, which expires at the noon on the 15th of the delivery. And these are the factors that will affect the FCPO market. Okay, so the first one, we have the weather season. So the plantation of the palm oil trees follows their specific season and period. The whole process from planting to harvesting, which takes up to 4 years, and their lifespan can be up to 25 years. So palm oil trees requires warmer weather, which the humidity environment to grow up healthily, as like too much rainfall could flood the plantations, and it will also affect the plant's growth and lowering the production. Second, we have the competition from producing country. So Malaysia and Indonesia is also one of the largest exporter, and both of these countries has taken up more than 90% of the supply to the world, as Indonesia expects to double their production by the end of 2030. While Indonesian production keeps increasing the output, it can cause the price to decrease and the profit margin of Malaysia will be affected. So Indonesia can supply most of the demanders in the market and also with better tariff rate. So for Malaysia, we also lose the competitive ability of being forced to sell at a lower price. Okay, and then we have competition from other edible oils like the price of the palm oil will also be easily affected by other vegetables oils like sunflower oil, corn oil, and especially soybean oil. Like when the bad water falls on the soybean plantation, it helps to increase the palm oil prices. US, Brazil, and Argentina are the soybean producer countries. So once their oil supply is below the market needs, palm oil will be the substitution. And other than that, China is the world's largest oil import country. So when those countries have massive production on vegetables oils, China will be tended to import oil which has the lowest price. And for fun, festive season can also increase the demand for oil. So people will use it for religious praying purposes. And with the high demand for oil use, the price also will increase too. So during the festive season, short of labor on harvesting the palm fruit, which will affect the supply to the market too. Workforce has extended their holiday and delaying the palm fruit harvest, which occurs the drop in production due to the losses of overripe fruit. So harvest the palm fruit on time can make sure the quality of the palm oil is good. So other than festive season, like China, India, and Europe are also among the largest importers of palm oil. While crisis arises in these countries like Eurozone debt crisis, slowing food demand, and global economic downturn, it will lead to decrease in demand for palm oil. And all of these consequences will be supply more than demand, which will lower the palm oil price. And last but not least, we have tariff and policies. Because Malaysia relies on exporting palm oil due to build up the country's economy. So to hit the GDP, like higher government may lower the tax rate to help in strengthening the exports and also to reduce the inventory levels. So this can make the liquidity if the market higher, which is more favorable to the traders. And one of it is that Australia, they had also proposed a bill of enforcing labeling palm oil as a product ingredient instead of vegetables oils, due to that they believe that the palm oil plantations have contributed to the deforestation. So with the lower demand for palm oil based products, so therefore affecting the palm oil price, of course, will go lower. Okay, so next I will be going on to the advantages in futures trading. So like in futures trading, what are the advantages? So we have the first one, we have low transaction costs, and then high liquidity, leverage. It is regulated by the Securities Commission, and of course, bi-directional trading. Okay, you can see from here, low transaction costs. So this futures market contract value, as this is just an example of the contract value. Okay, so from the first column here, on the middle column, the futures market column, you can see that for the contract value for one lot of FKLI will be about, one lot is at 1,006 and it will be about 80,000. Okay, this is in futures market, and the transaction cost will be, we only charge the brokerage fees that we have will be 30 ringgit, which means you buy and sell, you enter and you exit the market will be 15, so will be 30. We do not have stamp duty, we do not have clearing fees. So the total paid commission, the total paid brokerage fees will be 30 ringgit to enter and exit position. And then on the right side, you can see from here in the cash market, same, you will also have a contract value of 80,000, and the transaction cost, we have brokerage fees, we have stamp duty, and we also have clearing fees. But this one also depends on the broker house that you are referring to. So for this is just an example. So for the cash market, it will usually be about 840 plus or minus. So for here, you can see that the charges, the differences between the futures market and the cash market, the total pay commission differences will be around 800 plus minus. Okay, so from here, the futures market, of course, will have lower brokerage fees, lower transaction costs. Okay, high liquidity. So high liquidity, which means that when traders, they want to enter the market, in futures market, traders able to buy and sell easily. Like when some traders, they only enter one contract, so they will not face any difficulties like in selling off or closing their position. So from here, I've shown you that the crude palm oil and also FKLI. So I have so many contract months like September, October, November, and December. Okay, from here you can see that crude palm oil November 21, which is 2021, the November contract month has the highest liquidity. How do you know that which month has the highest liquidity? You can see from the volume side, comparing with other contracts months, September, October, and December, the volume for November has about 9,800. So from here, you can know that all the traders, the active month will be on the November month. And for the FKLI, currently we'll be trading on the spot month, which is also the active month, so which is the August. And you can see from September or December, the volume is much more lower comparing to the active month. Okay, and of course, for futures market, bi-directional trading, which means that you can either you're planning today the market will go uptrend, so you would long the market, and by closing your position, you would sell it. So maybe tomorrow the market might be going downtrend, so you will short the market, and by closing a position, you will buy back the market. So we usually call it uptrend or bullish, which is long, and then downtrend or bearish, which is short. So in futures market, you're able to go sideways, both ways, which is known as bi-directional trading. Okay, and the third thing is leverage. So what is leverage? So it also known as, it uses like a small capital upfront to trade a greater value contract. Okay, so from the side here, the long 1 BMT crude palm oil futures, in the cash market, you will have to pay a full value of about 1100,000. And in the futures market, you will only need to pay the initial margin of 6,000 ringgit. So for example, today, the market gains 50 points in a day, which means that the market goes uptrend 50 points. So one tick equals to 25 and 50 ticks equals to 1250. So in the cash market, what is the amount of the return of investment you will get? So result from paying a full value. So you paying 1100,000 to enter the cash market of the palm oil, and the earnings that you have made is about 1250. So your ROI will be about 1.14%. And you can see on the right side here, for the futures market, you only need to pay 6,000 for the initial margin, and you have earned 1250, which means that you have made a return of investment about 21%. You can see the huge difference here. So this is like when you make a profit in the futures market. But also in the same scenario, if you decided today, if you think that the market today will go downtrend, but today the market also gains 50 points. So the loss that you have made from paying a full value in the cash market will be about negative 1.14. But also in the futures market, you'll be losing about 21%. Of course, this is the difference. Like in the futures market, you will only need to pay 6,000 initial margin, but in the cash market, you will have to pay a full value about 1100,000. Okay, so margin call. So what is margin call? In margin call, it is when you're in the futures trading, in the futures market, margin call is very important. So margin call happens when the traders, they do not have enough account balance to hold their position overnight. Okay, I'll be giving an example here. Initial margin for one lot of FKLI will be 4,200 ringgit. And to hold overnight, which means that you need 100% of the initial margin. And so, but today, if today the market goes against you and your equity balance, you have about 4,000 ringgit. So how much will be your margin call, and what is the amount that you need to top up? Yes, so the amount that you need to top up is about approximately 200 ringgit plus minus. Make sure you are able to have 100% of the initial margin to hold overnight. If not, next day you will receive a margin call from the dealers. So okay, so margin call happens when, like today, you long one contract of FKLI at 1,005, and you have cash balance of 5,000 5,000 ringgit. So when the market drops to 1480, which means that you have lost about 1,000 ringgit. So you will have the unrealized profit and loss of 1,000 ringgit. The market closed lower and your cash balance, you only left about 4,000 ringgit. But you still hold your position until the next day. You're still holding one long of contract. So you only have a cash balance of 4,000 ringgit. So next day you will receive margin call about 200 ringgit amount. So you will need to top up the margin call amount to continue to hold your position. Okay. So in the futures market, we have market players lah. Okay, we have market players, like, because every market needs participants as like hedgers, speculators, and arbitrageurs. Okay, so what is hedgers? So hedgers is like they are looking for the reduction of risk. So while trading in derivatives, it is also a form of insurance against the unexpected price movements, the volatility of the markets, the uncertainties of the company performance and profits. So hedgers, for example, hedgers are like the people, mostly will be farmers, manufacturers, importers or exporters who wish to secure a future price for a commodity in order to protect themselves against the volatility of the commodity price. So in other words, hedgers uses futures contracts to protect themselves against the price risk. Okay, so hedgers are like commercial producers and consumers of the traded commodities. So usually, like for hedgers, right, they will participate in the futures market to manage their price risk, so to protect themselves against the risk of losses from the price fluctuations. And like take for example, in June, like a palm oil producer, they also expect to harvest at least 25 metric tons of palm oil in September. Let's say that the crude palm oil futures contract for September trades in June will be 4,000 ringgit per ton. So by selling the CPO contract at 4,000 in June, he can secure a price for his palm oil price and protect himself against the possibility of the falling price of the oil in September. So even though when the CPO prices were to drop to lower to about 2008 in September, so the producer had effectively locked in the prices of 4,000 ringgit by hedging it with the CPO futures. Okay, so the next one we have speculators. So speculators are people who analyze and forecast the futures market movements by trading contracts with the hope of making a profit. So speculators will put their money at risk and must be prepared to accept the outright losses in the futures market. So how do actually speculators make a profit? So speculators, they would offset their futures contract to their benefit. So to do this, speculators, they would usually buy a contract and then they would sell them back at a higher price than which they would purchase them. So conversely, they sell the contract and buy them back at a lower contract price than they sold them. In either case, if it's successful, a profit is made. So in other words, a speculator also can refer to as a trader, which are quite important in the futures market, as they also bring liquidity and assume that there is a market risk. So we also have arbitrageurs. So arbitrageurs are risk-free arbitrage techniques which returns a profit without any directional risk. This means that if arbitrage technique is applied properly, you will make a profit no matter which way the underlying asset moves. So actually arbitrage, they has been existed for as long as the capital market has, and futures arbitrage is always the way of taking advantage of the pricing difference between the underlying asset and also the price of the futures contract. So in fact, like every derivative instruments created on the same underlying asset, it gets slightly mispriced from time to time, and the arbitrageurs have sophisticated the programs to detect and take advantage of such minor difference in price. So arbitrageurs would be like simultaneously purchase and sale of two different contracts to take advantage of the perceived mispricing. So in pure arbitrage, mispricing is actually been locked and risk-free profit would made through the trades. Okay, yeah. So I'll be going into the introduction to the foreign futures contract. I hope everyone's still with me. Okay. So what is actually micro futures contract? This is for the foreign contracts, which means that it is the smallest contract in the largest market. So we have micro mini equity index, which has S&P 500, Nasdaq 100, and the Dow Jones, and then the Russell. Okay, and then we also have micro metals. We have micro gold, micro silver, and then the micro WTI crude oil. Okay, so for like micro E-mini futures, they will give all the traders a simple, cost-efficient way to access to the liquid equity index futures markets for a fraction of the upfront financial commitment. So for micro futures contract, which also means that it is a smaller contract margin, which gives more traders the opportunity to discover the benefits of the futures by lowering the amount of money required to enter the market. Okay. Okay, so why choose micro futures contract? We have strong global participation, precisely scale index exposure up or down, versatility to manage position, and also global trading hours. So for the first one, strong global participation. So for the micro futures contract, it is among the most liquid, actively traded equity index contracts available. So micro E-mini futures, they actually provide the same benefits of the normal E-mini futures, but in a smaller size contract. Okay, and then it is precisely scale index exposure up or down. So same goes to all the futures contract. It is able to do bi-directional trading opportunities. So with 1/10 of the exposure, the micro contracts might allow you to trade larger price swings. And if you view each contract as a smaller chunk of a larger position, you might also be able to better manage your position by adding or reducing the number of contracts you will be holding. And the third one, the versatility to manage your position. So it gives you the more flexibility for managing a position as the market conditions change. So using the contract which suits you the best to suit your goals and have the greater access to the liquidity of the market. And global trading hours. The global markets don't sleep. So this contract allows traders stock exposure and growth opportunities in a price-weighted index that offers almost 24 hours trading. Okay. And yeah, so we have so these are the micro E-mini index constituents breakdowns. For the first one, we have micro E-mini Dow Jones index. Okay, the micro Dow Jones is the index tracks on the 30 of the largest blue chip companies in the leading sectors of the US. So to be considered as under the Dow Jones 30 stocks, they have to meet the following criteria. It has to be incorporated and headquartered in the US, and it has attract a large number of investors and also have excellent reputation. So for the Dow Jones, we have a few examples. We have like Apple, McDonald's, Microsoft, Intel, and etc. So these are a few, and we have another 26 indexes. And then the second one, we have micro E-mini S&P 500 index. Okay, it is designed to manage the exposure to the 500 US large cap stocks tracked by the S&P 500, which is a broad-based market cap weighted index that tracks the 500 of the largest US companies. So it is balanced index for all sectors. We have also Facebook, Pfizer, Starbucks, Amazon. I guess you all are familiar with all these companies, and there's a list of it. Okay, and then we have the third one, micro E-mini Nasdaq. So for micro E-mini Nasdaq, it tracks the 100 of the largest domestic and international non-financial companies listed on the Nasdaq based on the market cap. So for mini Nasdaq, it is heavy on technology stocks. So we also have Apple, Netflix, PayPal, Baidu, and etc. So yeah. And then we have the Micro E-mini Russell. So for Micro E-mini Russell, it is a broad-based market cap weighted index that tracks 2,000 small capitalization stocks covering a wide variety of sectors in the US economy. So the Russell 2000 is considered as a leading benchmark for the US small cap stocks. Okay, so same goes to Micro E-mini contract specs. So every of them, they will have their own contract specs, and you can see from here, for all of these index, they will have their different contract size. So for E-mini Dow Jones, we have 0.5, and then for S&P will be $5, and then mini Nasdaq will be $2, and Russell 2000 will be $5. And of course, the trading hours, this will be based on Malaysia time, which is starting from 6 a.m. to 5 a.m. So they will be trading almost 24 hours. And for price fluctuations, for every indexes, we also have different price fluctuation. For Dow Jones, it will be 0.5, and S&P 0.25, Nasdaq will be 0.25, and Micro E-mini, the Russell will be 0.10. And the dollar value for one index point will be different for every product. So for the contract month, which means that the most active month for all these index will be trading on March, June, September, and December. And of course, because this is indexes, so will be delivered on cash settle. And the expiry date will be on the third Friday of all the contract month. Okay. Okay, so this just now will be on the indexes, and now we will be going on to the crude oil and also the metals, crude oil, gold, and silver. So for all the contract size will be different as well. For crude oil will be 100 barrels, micro gold will be 10 troy ounces, and silver will be 1,000 troy ounces. The trading hours will be the same, 6 a.m. to 5 a.m., almost 24 hours. And the price fluctuation also will be different. Same goes to the dollar value of one point of index point. And the contract month for crude oil will be on March, June, September, December. But for micro gold will be every February, April, June, August, October, and December. And then for micro silver, it will be January, March, May, July, September, and December. So for the delivery month, for crude oil will be cash settled. For micro gold and silver will be physical. But in Phillip Futures, we also will be cash settled. We do not have any physical settlement. And expiry date for all these products also will be different. Okay. So what are the factors that will also affect the foreign market? So the first one will be the gross domestic product, the GDP, which measures the value of all the goods and services produced in a country during a specific time period. So for GDP, it provides the basic measure of growth of contraction in an economy. So when an economy is healthy and growing, businesses are more likely to report better earnings and growth. And secondly, we have the unemployment rate and jobs report. So the monthly jobs report by the US of Labor Statistics can show that hiring is picking up or slowing down, both of which can be useful in predicting the future levels of the economic activity. And more people with job equates to the higher retail sales, economic output, and also the corporate profits. And consumer price and produce price index will, like for rising inflation, can also hurt the consumer spending, which makes up more than 2/3 of the GDP, and also causes that the Federal Reserve to raise the interest rates to control price gains. And also higher rates tend to cool the economic activity, and also have many stocks like rallies. Falling inflation and resulting in interest rates cuts have the opposite effect, igniting the stock rallies. And lastly, also the retail sales. And any extended drop-off in the retail spending could also be taken as a sign of a downturn in the economy, affecting the business profits and hiring. So an upswing, of course, can be taken as a bullish, giving the investors reason to push the stock's price higher. Okay, so up until here will be on the foreign market. Yeah, and then here I will be showing on you the FKLI historical data. Like, so this will be like for the month of July and August. So you can see from here, For the futures contract, it is actually quite volatile because from daily, as you can see from the red bracket here, for the July of 7 and 8, the price settled for the market settle will be on the 7th July will be on 1528, and on the 8th of July will be on 1503, which means that the market dropped. The market dropped 25 points. So every FKLI equals to 0.5 tick and 25 ringgit. So which means that 1 point will be 50 ringgit. So if you hold your position short, you will earn about 1,250 ringgit. So in the futures market, so no matter the market is going down uptrend, the market is going downtrend, you would also make a profit. Okay, and just now was the local market, and now this is the micro Dow Jones market. So for some traders, they would prefer to hold their position in the long term. So maybe they would, so for some of our traders, they would also hold their position for like a month long or 2 month long, depends on the traders trading pattern. So from here, you can see for the month of July, the differences of the highest point and the lowest point is about 1,449 points different. So 1 point of Dow Jones will be USD 0.5. So imagine if you have entered the market, so you will be earning about 1,448 in USD. So for Dow Jones, the market fluctuates 23 hours, and no matter for the US side will be our nighttime or the US side will be our daytime, as long as the Dow Jones is 23 hours, the market is moving and it is very volatile. Okay, so next I will be going on to the order types. So these are the basic things that you also need to know when you are trading in the futures market. So a market order, it is basically an order which to execute at the best possible price available in the current market. So this type of orders, they actually guarantees that the order will be executed, but does not guarantee the execution price. A market order will be generally used to execute at the near or the current bid or ask price. However, it is very important for the investors to remember that the last traded price is not necessarily the price at which a market order will be executed. And next will be on the limit order, which the order is to buy or to sell at a security at a specific price or a better. A buy limit order can be executed at a limit price or lower, and a sell limit order can only be executed at a limit price or higher. You can see from here, from the buy limit, if the example, the current market price is at 1,004, and if you want to buy limit, you will have to key in your order, the price that you want has to be lower than the market. So if it's sell limit, the price has to be above. So if you key in wrongly, your order will be rejected. Okay, next we have stop order. So a stop order is an order to buy or sell at a stock at the market price once the price has traded or through a specific price. So if the price reaches the stop price, the order becomes a market order and it is filled at the next available market price. So stop order is actually able to minimize a loss on a long or short position. It also could be to protect a profit on an existing long or short position. It is also could use as to initiate a long or short position. So the main function of a stop order is to minimize your long or short position. Okay, and from here, I'll show you the difference between the futures market and also the stocks market. Okay, from the futures market, it is traded on an organized exchange, and then in the stocks market, it can be traded on organized exchange or also over the counter. So in the futures market, you are the ownership of corporation, and you will not be entitled for any dividends, and you are able to do a short selling, and usually in the futures market will be in the short term for the payment. And yes, of course, futures will an initial margin amount is required. So objectives of the futures trading will be hedging, arbitraging, or speculating. Okay, and in the stocks market, you will be the ownership of a corporation, and of course, you will be entitled for dividends And for ability to short selling, it is also maybe vary for different stocks. And for the stocks market, usually traders, investors, they will hold the stocks market for long term, 1 month, 2 months, or maybe up to a year. And for the stocks market, you will also need to pay a full amount to buy the shares. And stocks market, the objectives will be on the investment purposes. Okay, so before we end, so how to kickstart your futures trading? So you will have to open an account with us, with Phillip Futures. You will have to know your risk appetite and to study the products which are more to your interest. It can be local, it can be foreign, it can be commodities, it can be indexes, it can be energy futures as well. And then you will have to understand the fundamental analysis and technical analysis. So fundamental analysis will be based on like news or daily, like the micro mini, as I mentioned just now, the jobs or anything. And the technical analysis will be based on indicators that which you are suited to. And then you can start your trading journey. Make sure you are always up to date with the market. Like for the futures market will be based on the market daily. So whether the market is uptrend or downtrend, make sure you are always up to date. And you have to keep learning, of course, and also happy trading with us. Yeah, so that's the end of my presentation for today. We have about 5 minutes left. I think I will take up some questions. So if you have any question to ask, you can just type them into the question box and I will address the question. So if you guys have any questions which you are not very sure, you could type them in the question box and I'll address them. And yeah, if from here you can see that we have online account opening. If you're interested, you can just directly scan and just fill up your details. And or if you want to try our demo platform, you can scan on the right side, which will link you to our demo account. So you will have a look at how our Phillip Nova works. Okay. So we have one question from Mr. Lim. What's the minimum deposit to require to be qualified for the margin trading? So for every product, we'll have different initial margin. Like for example, the micro contracts we have about 4,000, 5,000. Depends on the products which you are more to interest. Like FKLI just now was 4,002, and then the FCPO will be 6,000. Okay. Yeah. Okay, so I also have another question is that by Mr. Lim as well. So like how do you know how to know which contract month is the most active month? Okay, because we have for futures trading, we have a lot of contracts month. Like for just now, I've shown to you for the palm oil, we have August, September, October, November, December. So you are not sure which month. So you will just trade on the month with the highest volume. So as I showed you just now, we have like some month that only have a few hundreds volume, and then some month we have up to 4,000 or 5,000 volume. So you are just based on the contract on the volume to determine which month you are more interested. I mean, have the most active month. Okay. And okay. So another questions that I received is what are the margin requirements for the US contract? Same goes to every product. It also depends on every product. So it range between, for the micro contracts, it range between about 4,000 to 7,000. Yeah. So like from Dow Jones need about 4,000 too. So for every contract, to enter one lot of contract, you need about 4,300 to enter one contract. It cannot be more than that, and it cannot be less than that. It has to be, it's better to have more than the contract. So you just have to make sure you have you have enough amount to enter one contract. So for example, if for 4,002, if you want to enter 2 contract, you will need 8,004. Okay. Okay, so hold on, let me see on the questions. Yeah, so if so if you are interested to open account, or if you would like to know more deeper, you can contact us, and we also can arrange a one-to-one coaching session with you. Yeah, so because a webinar will be just like for everyone, and also I've received some of your Google Forms that most of you are basic. So if you would like to know more, like maybe you still don't understand, you can contact us. If you can just contact us, and we will arrange for a one-to-one coaching session. Okay. Okay. Yeah. So I think the time is also almost up. So thank you, everyone. Thank you for your time attending my webinar today. Okay, and remember to check out our ongoing promotion and grab the opportunity to join it. So with that, I think I will also end the session for today. Thank you, everyone, for your time, and good night, everyone, and stay safe. Thank you, everyone.